From London, in for Emily Chang, and this is Bloomberg Technology. Coming up this hour, the chip crunch gets a White House hearing. President Biden hosts semiconductor and automakers as part of the summit to try to smooth out supply chain issues. Meanwhile, Nvidia has big plans to make its own server processors, bringing yet more competition for Intel. We'll have the updates and analysis across all things chips. Plus, striking deals. U.S. Senator John Ossoff helps broker a deal between South Korea giants SK Innovation and LG Energy. At stake, sprawling factories in Georgia that will supply batteries for EV makers. We'll hear from the senator on that and more. And coining it in, Coinbase sails towards a $100 billion valuation as it goes public this week. We talked to VC Sarah Kuntz of Clio Capital, who was in crypto before crypto was cool. Those stories in a moment. But first, when investors took a cautious tone Monday as US stocks took a pause from record highs, and as we look ahead to earnings, debt sales, all important eco data, who's got it for us? Ed Ludlow with the latest. Take it away.
Yeah, it's almost like we were treading water a little bit. We get that CPI data on Tuesday. Investors have half an eye on the bond market, particularly with regards to supply. The S&P 500, the main gauge of US equities, basically flat, slipping off slightly from record highs. The NASDAQ 100, that tech-heavy index, off by 0.2%, but no sort of real underperformance. And bond yields not really doing much. US 10-year up by less than a basis point, 1.67%. Really, the story, as you say, semiconductors. The Philadelphia Semiconductor Index down by 1.1%. Biden hosting the industry and their customers at the White House. His message really one of reassurance that he has bipartisan support to get the funds needed to fix the supply issue. Flip up the boards, though, because this was actually the story. NVIDIA coming into the CPU space, the long-time strength of Intel, and you can see what it did. The biggest points mover on the S&P 500, up 5.62%. Intel plummeting 4%. Come with me into my Bloomberg and look at this chart because it tells the story of the day of what happened on Monday. You can see there the blue line as NVIDIA spikes on that news, the S&P 500 followed. But after that, we lost a little bit of steam, a little bit of momentum. Come back to me and look at my final board, which is the Philadelphia Semiconductor Index. It has been plagued with volatility for weeks and months now, but we're still up 9% on a 3-month basis. You know, the supply shortage, good for those chip makers when they're supply constrained, but there's a lot still to work out, and I know there's a man standing by to talk to you about that, Caroline.
Yeah, certainly do. Bloomberg's Ed Ludlow, great run through across all things markets, and he sets us up perfectly for talking about Monday's virtual White House meeting with President Biden, telling companies vying for a sharply constrained global supply of semiconductors that he has bipartisan support for government funding, well, to address a shortage that has idled automakers worldwide. For more, let's bring in Bloomberg's Ian King, who covers the chip industry for us. Ian, is anything possible to fix this in the near term?
Well, I think even before the meeting, the answer was unfortunately no. Doesn't really matter whether Joe Biden had given them all $1 trillion or instructions to get on it right now. Realistically, it just takes so long to actually make a chip and then to put a new factory in place that short term there is no easy answer here.
You spoke with a key CEO who had attended the summit. What was the download?
Yeah, I mean, I spoke to the CEO of Intel, obviously a major stakeholder. He was very positive. He said, look, you know, as Ed just told us, support on both sides of the house. Everybody was, like, wanting to work together. On the flip side, though, there were a little bit of, I think, sort of disagreement. Obviously, the automakers are there saying, we need something right now. We need something right now. We need to be front of the queue. We need to have priority. Others on the call were saying, no, you don't. And we need to take a more holistic view about this. So there was a little bit of debate, I think, and obviously, you know, the funding and the corporate tax rate, that would seem to be a little bit at odds with what some of the chip makers want as well.
Oh, to be a fly on the wall. Meanwhile, talk to us about, well, the combative nature that is within the chip sector. I mean, we saw it on full display today. NVIDIA coming in, grabbing yet more of Intel's space. What do you make of the move into CPUs?
Well, you know, NVIDIA is trying to downplay this as a competitive play. They're saying, look, this is very much at the high end of the server market for, you know, the very most difficult AI workloads. But the simple fact is that most of that work right now is done by Intel chips. So if NVIDIA are coming in there, They're coming in at the expense of those who are already doing that work, and that is primarily Intel, and there's no getting away from that.
Certainly is, and that's why we saw the ramifications on Intel stock, AMD stock as well, inking across all things chips for us. We thank you so much. Meanwhile, you wouldn't expect a company to actually thank regulators after getting hit with a fine, much less a $2.8 billion fine. But hey, I mean, that's what goes on in China, and the e-commerce giant Alibaba doing just that to thank the Chinese government after being hit with this landmark fine. Bloomberg anchor Sherry Ann is with the story, and remind us why, Sherry.
Yeah, I mean, you wouldn't expect really tech companies here in the U.S. go about thanking regulators for that record fine, right? But that's what happens in China, and Alibaba coming out with a statement saying that they're full of gratitude and respect, saying that they would not have achieved that sort of growth without sound government regulation and service. So we actually saw Alibaba, after being hit with this record $2.8 billion fine, surge in the New York session, surge in Hong Kong as well. We're talking about the best day since June 2017 in New York. A couple of things. Bloomberg Intelligence saying that this record fine is a small price to end uncertainty. Jeffrey saying that this is a new starting point for Alibaba. And as you can see right there, if you put this into context, it's only 4% of 2019 revenue, 11% of free cash flow. When you're talking about a company that has more than $250 billion in assets. So Raymond James now saying that they expect solid, continued China e-commerce growth, that the valuation for Alibaba is still attractive. They maintain a strong buy rating.
And Sherry, it's sort of not changing inherently their business model that much, but that's quite different from the other key company that we associate with Jack Ma, which is Ant Financial, which is going to have to completely sort of reorientate itself to a certain extent because of regulation once again.
A complete revamp of their business for Alibaba. They are staying with their core businesses, but everything else is changing, and they will be supervised more like a bank. So we're talking about authorities asking them to eliminate unfair competition in payments, also increase oversight of consumer lending processes, not to mention that they will be transformed into this financial holding company. Now, they have to ramp up data protections as well. They will need to cut the value of their money market fund, Yuebao, as well, and they will return to sort of their origin story, focusing on micropayments and convenience for users. So regulators making it harder basically for Ant Group to exploit synergies that sort of direct traffic from their payment services, Alipay, to other financial services. Now, what sort of implications will this have for their IPO? That has been the big question. Remember that $35 billion mega listing that they had to scrap last year? Bloomberg Intelligence now saying that their valuation could drop about 60% from the $280 billion that it was pegged at last year.
I mean, it's just mind-boggling, really, the fall from valuation, the fall from grace for Jack Ma. But also, this must have implications for other people running big businesses or even startups over in China at the moment as to how does it impact the rest of the landscape?
It was really interesting because Alibaba CEO Daniel Zhang, speaking at a conference call last night, was saying this is not just about Alibaba. This is about a global trend where you're going to see more regulation. So, not surprising, we actually had pressure for JD.com, for Baidu in the New York session, for Tencent, for Meituan in the Hong Kong session as well. Beijing wants to also create an entity to oversee internet data, according to sources, not to mention that they're going to start curbing market concentration in online payments. We've already seen it with Ant Group. We are expecting that to happen with Tencent. Pony Ma's Tencent has been warned by China's antitrust watchdog as well. So we're watching those developments very closely, Caroline.
And you certainly will be when, of course, you take to the helm, Sherry Ann, the co-anchor of Bloomberg's Daybreak Australia and Daybreak Asia. You do not want to miss her programming. There'll be plenty on this story to come, I'm sure. We thank her for her time just now. Meanwhile, coming up, well, 2 South Korean EV battery makers ended their trade secret spat, ending a 10-year import ban into the US and saving thousands of jobs in the state of Georgia. Senator John Ossoff of Georgia and Bloomberg's David Weston join us next to discuss that settlement and the new, well, controversial voting law. This is Bloomberg.
For our Bloomberg TV and radio audiences worldwide, I'm David Weston, and we are joined by a very special guest right now because he is the man of the hour. There's a big drama being played out in the state of Georgia over the weekend about whether, in fact, a major battery plant for electric vehicles would come to pass or not. And Mr. John Ossoff, the senator from Georgia, was brought in. He got the deal done, and we're delighted to welcome him now to Bloomberg. So first of all, Senator, I think I have to congratulate you because there was a lot at stake in this. It wasn't clear what happened. Give us a sense of how you got it done. As I understand, President Biden asked you to intervene.
Well, David, thank you for having me, and it was an extraordinary team effort. I want to commend in particular the United States Trade Representative, Ambassador Catherine Tai, her staff, and she did an extraordinary job bringing this to a successful conclusion. And I got involved because this is a matter of Georgia's economic interest, 2,600 skilled jobs at this SK Innovation facility that's being built in Commerce, Georgia, billions of dollars of investment in Georgia's economy. And this is a strategic investment because we're talking about electric vehicle battery technology. The United States needs a diversified supply chain so that our auto manufacturers can access this technology so they have a choice of vendors. And we don't want to rely exclusively upon import in order to provide our automotive industry with this electric vehicle battery technology. But there was a significant intellectual property dispute between SK and LG. The options that were apparent were for President Biden to consider a veto of the ruling by the International Trade Commission. That veto would have allowed SK to continue construction of this plant in Georgia, but at the cost of the integrity of our intellectual property legal regime. So I stepped in, the parties were at an impasse, I urged them back to the table. We got a negotiated settlement. LG has withdrawn its complaint at the ITC against SK. SK can continue with construction of this $2.6 billion facility in Commerce, Georgia, and 2,600 Georgians will be employed in skilled jobs producing electric vehicle battery technology.
And Senator, that is where the high drama comes from. I mean, it's in the area of climate that is a priority for the Biden administration. It is electric vehicles, which are terribly important. At the same time, protection of intellectual property is as well. Can you give us some sense of how you reconcile this? Because these two parties have been in dispute for some time. And as I understand it, you're right up against the deadline from the International Trade Commission about banning imports from SK.
That's right. The president had 60 days from the International Trade Commission's judgment to determine whether or not he was going to veto the ITC's ruling. And that put the administration in the unenviable position of having to make a choice between the production of strategic technology in the United States, electric vehicle batteries, which are a vital part of our transition to a clean energy future, a geostrategic technology where we face substantial competition with China, and on the other hand, potentially eroding confidence in intellectual property law in the United States, because in order for major industries to undertake significant research and development, in order to attract foreign direct investment, there needs to be confidence that intellectual property law in the United States is robust and enforced. That's why a settlement was a vital and necessary solution. The parties are no longer at odds. A payment has been made from SK to LG so that LG withdrew its complaint at the ITC. The intellectual property law regime is intact, and Georgia's going to get these 2,600 skilled jobs. The United States will have a diversified electric vehicle battery supply chain.
Senator, can you give us some sense of how long this settlement will last for? Because obviously SK is investing a lot of money in that plant in Georgia. We would not want to have this dispute come up again in another 3 or 4 years.
No, and look, they would have faced only 2 years in the case of production of one battery component, or 4 years in the case of production of another, before they had to shut this plant completely. Now, this dispute is behind us. The ITC matter has been fully withdrawn. The parties are no longer fighting it out over this intellectual property dispute. SK is continuing with this $2.6 billion investment in Georgia. I believe it's the largest foreign direct investment ever made in the state of Georgia for this plant that will employ so many people producing technology vital to our clean energy transition.
What took it over the top?
A lot of hard work and relentless pressure on both companies to come to a deal. Look, these are two South Korean industrial titans. both of whom have invested many billions of dollars in electric vehicle battery technology. And it took a lot of hard work by a lot of people. And I want to again commend the United States Trade Representative, Ambassador Catherine Tai, for her extraordinary contributions to the efforts to bring these companies to the table, settle the dispute, allow the ITC matter to be put to rest. With just hours left on the clock, President Biden called me on Saturday afternoon to confirm that the deal had indeed been reached and construction of the facility in Georgia could therefore continue.
So, Senator, this is not to suggest anything at all, but why did the president pick you? What in your background prepared you to get this done?
Well, I don't think the president picked me. Look, I stepped in here because Georgia jobs and Georgia's economic growth were at stake. Again, 2,600 skilled jobs in and around Commerce, Georgia. This will be vital employment, generating wealth, generating opportunity for Northeast Georgia and statewide for decades to come. And David, this is going to attract other firms in the clean energy space to build and locate facilities in Georgia and create more jobs. These supply chains that are becoming increasingly integrated, the fact that we have electric vehicle battery production, one of the most significant production capacities now moving into Georgia, means that other firms involved in the electric vehicle space and the clean energy space are going to come to Georgia. I welcome them to Georgia and look forward to working with them to create more jobs in Georgia.
Senator, it was widely reported beforehand that LG was insisting that the deal totaled $3 billion. I don't know how much is confidential, how much not, but did it basically get what it wanted?
So the agreed settlement was a $1.8 billion payment from SK to LG, and the matter before the International Trade Commission has been resolved. And as your viewers who have been involved in complex, high-stakes negotiations know, moving those numbers over time takes a lot of work. It takes a lot of pressure. Both parties need to understand that their incentives are aligned so that they need a deal, and it takes a deadline. And it was with the clock ticking, just less than 24 hours to go until that plant might have been shuttered, that we were able to get a favorable resolution, save the plant in Commerce, Georgia, end the intellectual property dispute, and make a huge step forward for clean energy technology, electric vehicle production in the United States.
Senator, I want to leave it where I started, with just congratulations. It seems like a wonderful deal for the state of Georgia. Thank you so much to Senator John Ossoff of the state of Georgia. He is, of course, a Democrat. There's going to be much more coming up on Bloomberg Television and Radio.
It's a pretty big bet in the health space. Microsoft has agreed to buy Nuance Communications in a deal valued at almost $20 billion, including debt. Now, that represents a cool 23% premium to Nuance's closing price on Friday. And Microsoft has been working with Nuance on artificial intelligence software that helps doctors capture patient discussions and integrate them into electronic health records. Bloomberg's Leanna Baker joins us now with the inside track on why health AI. Is it all about telehealth at the moment, or what else is it that Nuance is going to bring to Microsoft?
There's a few angles here. Microsoft's cloud computing platform already worked with Nuance sort of behind the scenes to capture all this big data that doctors can now collect from patients and from medical records to look for different patterns. So Microsoft will get a benefit from its cloud computing platform being used. But it also is a new vertical for Microsoft going after the healthcare space. So this is a really big bet and a new area. It's Microsoft's first big deal in healthcare. So we'll see how it pans out. It's definitely a new application for Microsoft. And Nuance also has older technology. It's been a publicly traded company for a lot of years. So it's sort of a bet on the future, but with a company that has revenue and profit. So it's a pretty interesting move. Its biggest deal since LinkedIn.
Who'd have thought it? Revenue and profits. But talk to us more about, you said it's the second biggest to the LinkedIn deal. It's interesting that Microsoft closed flat on the day, which basically shows that 20 billion, I mean, it's nothing in comparison to the company's cash and nothing in comparison, certainly, to its market capitalization. It can certainly afford it. But what does it speak to in terms of Satya Nadella's overall M&A playbook here?
Microsoft is a massive company. You mentioned $2 trillion market cap. It takes a lot to move the needle. They've been attacking different areas in M&A. Earlier this year, there were reports that they were looking at a $50 billion+ deal looking at Pinterest. We've reported that they've been looking at the audio, chat, and text app Discord. So they have a huge corporate development team, which is looking at all of Microsoft's big areas, whether it's Xbox or cloud computing or for the Windows platform, to see what companies could sort of fit in there. So it's true, a $20 billion deal for Microsoft isn't that big, but it's still the second largest to date.
Yeah, it's not to be sniffed at, and it's also wonderful when you've got a 23% premium coming your way if you happen to be owning Nuance. But talk to us about Nuance in general. They've been working together, as you said, behind the scenes. Why now? Because Nuance has been around for a while.
Nuance is a company that has been transforming the past few years. In 2018, they got a new CEO. They had a bit of shareholder pressure, and they really needed to clean up a few things. Since then, they've spun off an automotive company, which is now a separately publicly traded company called Cerence. They sold a bit of the company to private equity. So it's almost like they were preparing to slim down to be more attractive, to focus on a few key areas that were growing fast, like their healthcare transcription and artificial intelligence capabilities. Remember, they developed the technology that led to Apple's Siri product. So they've been doing this for a while.
Liana Baker, thank you for bringing us that story on all things Microsoft. Meanwhile, let's bring you some other tech stories we're covering. Apple's been a laggard in the smart home space. A versatile new device that's in early development could change that fact. Bloomberg's learned that the company is working on a product that would combine an Apple TV set-top box with a HomePod speaker. It also would include a camera for video conferencing through a connected TV and other smart home functions. Meanwhile, coming up, of course, we've got to talk it. Coinbase expected to go public this week at a staggering valuation of about $100 billion. We'll look at the company's numbers and what's going public means for the larger crypto space with Clio Capital Managing Director Sarah Kunst. Stay with us. That's next, and this is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in London this evening, filling in for Emily Chang. And for a look at what happened in the markets, we're joined by Bloomberg's Ed Ludlow in San Francisco. Take it away, Ed.
Well, in your honour, I actually wanted to stay with London and talk about Darktrace. This is the British cybersecurity firm that announced on Monday it plans an IPO in London. And it's interesting because it's the first kind of big listing candidate since Deliveroo, which of course was not the most successful tech IPO. But it is exciting in its own right. Flip up the boards. It could be valued at between $3 to $4 billion on a London listing, which is kind of interesting. One of the criticisms with Deliveroo was its dual-class structure, which gave Deliveroo's CEO control for 3 years. Not so with Darktrace. They plan to do just a normal single-class share structure. They want to raise funds so they can fund their development. Of course, in the wake of SolarWinds hacks, Microsoft Exchange server hacks, I thought this was interesting, quite opportune time to plan a listing. They also plan to sell 20% of the company's equity. But you do want to bring it back to Deliveroo. So flip up the boards a final time. And it really tells the story of what was the poster child, and I know that that's a cliche, for London IPOs in 2021. 7 days of trading, we're down 35% for Deliveroo. And it was really interesting in an interview on Monday, the Darktrace CEO was at pains to say, it's exciting for London that we're going to do a listing in the city, but don't paint us with the same brush as Deliveroo. She loves Deliveroo, but we're very different companies. So that's definitely one to watch going forward. What will the investor appetite be in the wake of Deliveroo for a cybersecurity firm like Darktrace that specializes in AI, that detects and prevents cyber attacks? Definitely one for you to watch in London, Caroline.
Certainly is, and always a pin-up when they have female CEO, female CFO as well. It's a really diverse business over there too. So we thank you, Ed Ludlow in San Francisco. All eyes on, well, the global story of potential listings. And in the US, it's, of course, got its eye on its own big market edition this week. All eyes on the crypto company that is, of course, Coinbase, direct listing. I want to bring in Bloomberg market reporter Shonali Basak in New York, who helps us welcome Sarah Kernst, of course, Clio Capital Managing Director, former Senior Advisor for Bumble. And Shonali, we thank you for helping bring us this interview, and take it away with the first question.
Thank you so much, Caroline, and thank you, Sarah, for joining us. Let's start with the math on Coinbase, because it's expected to have about $100 billion in valuation as it goes public in terms of market cap. But does the valuation make sense relative to what it earns? We know it's profitable, but is it worth $100 billion?
I mean, that is a lot of money. And that is, to put it in perspective, right, JPMC is worth $475 billion. So, $100 billion is a lot of money, especially when, you look at the fact that their assets under management are not super high. Right. So they have, 43 million accounts, but they only have about $2,000, per customer on average, compared to a Schwab that has 9 trillion under management with 31.5 million accounts and almost 200%, over 200% more, when it comes to sort of assets under management per customer. And so, this is a really, really big bet on a very, very nascent player still.
Well, that's interesting because, there's a chance that this then goes public. What does it mean for those retail investors that are buying in? Is this kind of the top, very expensive valuations? Is there a risk that it falls?
I mean, there's always a risk that it falls, but the interesting thing about Coinbase is they make money when you buy or when you sell. So as long as you believe there's going to be volatility in crypto, and pretty much as long as crypto's been around, you can count on the volatility, Coinbase can still make money. I think the bigger question long term is when there are dips, are they losing customers? Are people selling and getting out of crypto? Or is there a constant feed of new people who are interested in getting exposure, AKA new customers, to drive more buys and sells?
Sarah, we thank you for joining us on this occasion. And for complete transparency here, my husband is a senior manager at Coinbase, so I know a bit about the business from behind the scenes to a certain extent, but I'm interested in your perspective on, you talk about comps. What's been fascinating to watch from a public perspective, public market perspective, is the rally that we've seen in MicroStrategy going very long into the crypto space, the right blockchains, the desperation for investors to want to get into some sort of public equity that is linked to crypto, perhaps don't have the risk tolerance for buying crypto on and of itself, or the ability to. How do you think it'll affect those sorts of companies? And is it the institutional buyer that you're expected to come in here?
I think that we're going to see a lot of retail investors come in here. This has sort of been, the past kind of 6 months have been the dawn of this sort of hyper online kind of millennial Gen Z retail investor. We saw that with GameStop. I think we've seen that with Robinhood. And I think we'll see some of that here, right? We see that with Tesla. A lot of what's driving up Tesla's market share is just the sheer belief in Elon Musk. And a lot of that comes from his Twitter followers, right? So, there's certainly going to be an element of that. But institutional investors were slow to come into crypto. And now it seems like every day there's a major headline about another huge institution that's trying to figure out its crypto exposure. We have ETFs that are on the market in the Canadian Stock Exchange. We've seen repeatedly companies like Gemini, a Coinbase competitor, try to bring forth ETFs in the US. And I think that realistically, we have to assume that in the next 12 to 24 months, we will see a US-based crypto ETF. But in the meantime, Coinbase really is your opportunity to get the public market exposure to this, to cryptocurrency.
And maybe then thick and fast, we might see the likes of Gemini and other companies come rushing to the public market once it's been opened with Coinbase. Sarah, your perspective on, therefore, the competition, because there is Binance out there, there is Gemini. How much of a moat does Coinbase have?
You know, I mean, Coinbase has a lot of accounts, and they have a lot of retail investors. They have not leaned in nearly as much on institutional investors, which is where other players like Gemini have sort of leaned in more from the beginning. But the reality is, you know, at scale, there's a real question here of, is Coinbase just a crypto exchange, or is it maybe sort of a Trojan horse of one of the biggest neobanks, right, that we have yet to see? You know, Chime in early 2020, Chime, the neobank that recently raised money at a $14.5 billion valuation, they had 8 million customers. So Coinbase is much bigger already. They're offering things, you know, like savings and earning interest on your savings, even though it's not FDIC insured. They're offering, you know, some credit and debit instruments. So what could end up happening is it could be that Coinbase really becomes the neobank for a slightly younger generation of retail investors, and crypto becomes a service they offer, not the service.
You know, thinking about the future of Coinbase, not just, you know, where it can expand in terms of different products, in terms of more banking services, what is the likelihood, especially given the regulatory environment right now, that it gets taken out, and who could take out Coinbase?
I mean, almost no one can afford Coinbase, right? I don't have an extra 100 billion in my pocket. But I think that there are a couple players that you have to at least consider, right? Some of the more obvious ones, the JPMCs, could they afford it? It'd be incredibly expensive, but probably. I mean, the you know, $2 trillion elephant in the room always when you talk about technology is Apple. And we've seen Apple with Apple Wallet, we've seen Apple with Apple Card, Apple Pay. They've increasingly gotten into the payment space. Is it a bridge too far to say that Apple could wake up one day and say, hey, maybe we want to own Coinbase? I don't know. I think really in this moment, you know, all options are on the table, and they're one of the very few globally that could certainly afford it.
Sarah, let's talk a little bit about your own experience and how you're going to be looking for the next pre-seed sort of disruptor such as that's going to come in Coinbase's wake. I mean, I loved going back through your Twitter feed and how, I think it was back in March, you tweeted out that basically back in 2011, you were telling anyone that you went on a Tinder date with, to buy Bitcoin, and you're saying like they owe you massive finder's fees now if they bought anything off the back of it. So you've been tracking crypto for a long time. You've had experience working with the Winklevoss twins. I'm interested in what you're looking now at in terms of DeFi, in terms of, are you looking at any fintechs that resemble a Coinbase or look at the crypto space?
I mean, I think decentralized finance, and I think the blockchain, particularly for contract use, is still incredibly interesting. And I think that there's still a lot of room in the market for crypto to grow. The entire cryptocurrency market cap is only $2 trillion. And that means it's slightly less valuable than Apple. Half of that market cap is solely Bitcoin. And so there's certainly room for stable coins. You know, we're seeing right now the rise of NFTs and Ethereum, the underlying, you know, sort of technology behind those. And I don't think that those markets go away. I don't think that, you know, the collectors markets, which is largely the use case of NFTs right now, non-fungible tokens, in things like art, in things like selling your tweets, right? I don't think that goes away overnight. I think that, you know, crypto has for a long time been a protocol in search of a use case. And up till now, the use case and kind of day trading, but I think we're really at the dawn of a more broad set of applications.
In search of a use case. I love that turn of phrase. Meanwhile, we all look at the Sotheby's and the Phillips auctions for NFTs that's starting today and watch and wait for the next headline number. Sarah Kernst, absolutely great to have you with us, Clio Capital founding partner. And of course, Sonali Basak, we thank you so much for helping bring that interview to bear. Meanwhile, coming up, one company that's helping others go green and why they say remote work may, in some cases, actually be worse for the environment. Our work-shifting conversation is continuing next. This is Bloomberg. So over the last year, millions of people around the globe shortened their commutes by transitioning, of course, to a digital workspace and turning their living rooms into offices. From ditching time in traffic to no longer having to warm up the car on a cold morning, of course, not having to get in a plane either. The climate impact these changes have had on the globe should have seen improvement. But one company is saying, hey, it's a bit more complicated than that. Although companies around the world are continuously joining a pledge to eliminate net carbon by 2040, with more employees working remote, it's the households that may not necessarily reflect the green models that, say, an office building might. BlackRock CEO Larry Fink, of course, compared climate change to the pandemic in his 2021 letter to CEOs, saying, "I believe that the pandemic has presented such an existential crisis, such a stark reminder of our fragility, that it has driven us to confront the global threat of climate change more forcefully and to consider how, like the pandemic, it will alter our lives." Now, as part of our work shifting series, joining me now for more on this is Watershed Climate co-founder and president Taylor Francis, who making it easier for companies to ensure that they're on the right climate track. Talk to us first and foremost, Taylor, about the calculator. What is it going to help companies do?
Yeah, Caroline, thanks for having me on. You're right. Everyone is wrestling with this. What does work look like post-COVID? And at Watershed, we build software that helps companies decarbonize. We build software that helps companies think about the climate and carbon impact of every business decision that they make, and return to work is no exception. You're right, a lot of people think that remote work is good for the planet, and it's true that less time commuting means less emissions from transportation. We're publishing this calculator today to help companies think through the impact of different scenarios. And what we've seen is that it's more complicated than meets the eye. So remote work is good, but not if it comes at the expense of people moving to suburbs, buying bigger houses, buying bigger cars. That means that the carbon impact of their own lifestyle, which may not show up on their company's carbon balance sheet, may actually increase. So it's important we get this right. It's kind of a rare opportunity to reset how the workplace works, and a rare opportunity to reduce emissions from that.
And Taylor, how many companies are wanting to be presented with that full supply chain reality? Does it give yet more fodder for the Larry Finks, who's very publicly said, I'd quite like people to come back to the office because of culture and all that? Is there another reason for a climate change perspective? How many companies want to understand, whether their employees have a kind of gas-guzzling car or a not particularly efficient home?
I think a lot of companies are thinking about this. And in this climate space broadly, you mentioned Larry Fink, you mentioned BlackRock. The expectation is that companies think about their climate impact really broadly. And so that means they look beyond their own office to the emissions of their employees, of remote workers, also their customers and their vendors. So I think the important thing here is that all these different pieces are interdependent. And the companies we work with, Shopify, Square, Stripe, are all thinking about the big picture here.
The big picture, and you can help get to the big picture much faster than usual. Talk to us about how some of the products you're doing is helping speed up this math, basically.
Yeah, every company is wrestling with climate today. It's become a business imperative as well as a planetary emergency. And what companies are finding is that climate is a data problem. Your carbon footprint as a business lives in your supply chain. It lives in thousands of different companies that are making the products that you buy. It lives in utility bills and purchase orders. And so we've built software that helps a company upload a bunch of raw data and turn that into a plan on how they can reduce emissions, how they can source from different suppliers. And all of that adds up to businesses able to get to net zero carbon faster, as a part of the core way they do business.
Watershed in and of itself is moving pretty fast too. What you launched in February, you already had backing from Sequoia, Klein & Perkins, of course, the two founders of the company that you've started at, of course, Patrick and John Collison founded Stripe, and this is where you and your co-founders came from. Talk to us about the momentum you have at the moment and where you hope to take Watershed Climate.
Yeah, so we started Watershed back in 2019. We announced the company just in February. We just announced our Series A. I think the thing that we're really excited about is the customers we're working with. So we're working with Shopify, with Square, with Stripe, with Sweetgreen, with MongoDB. All these companies are growing quickly. They all have aggressive goals in every part of their business, and they're looking at climate the same way. And so we're trying to help them make climate not just something you kind of publish a sustainability report PDF about once a year, but actually a part of how they design products, design salads, ship products to customers. And you're right, the momentum is pretty significant. I think it's amazing to see every company thinking about climate for the first time, and I think that that's going to be inescapable over the next decade.
I'm going to be proactive rather than reactive. We thank you so much, Taylor Francis, President and co-founder at the Watershed Climate. Really great to have some time with you. We wish you well. Meanwhile, still ahead, an overview of the White House Chip Summit, where President Biden addressed the shortage that has idled automakers worldwide. We'll get perspective from an industry analyst on Biden's response. That's next. This is Bloomberg. So, of course, as we've been covering all day, more than a dozen CEOs, including chiefs of Alphabet, General Motors, Ford, when they met with President Biden, virtually, of course, this Monday, vying for a sharply constrained global supply of semiconductors. Biden said there is bipartisan support for government funding to address the shortage. So to discuss all of whether really the U.S. government can do anything and plenty more of action in the semiconductor space, Stacey Raskin's with us, Managing Director of U.S. Semiconductors at Bernstein. An eventful day, perhaps not as eventful as we'd want with the White House, but I mean, you were writing back in February about some of the meetings that were going on bipartisan nature, the fact that the U.S. government was looking at these chokeholds.
Yes.
What are you seeing in terms of the bottlenecks and whether the U.S. can really address any of it?
Yeah, no, I think it's important to disaggregate. There's two issues going on. One is the current shortage situation, which is there and it's potentially getting worse. And then the other is a perceived over-reliance on Asia, Taiwan, and that part of the world for semiconductor manufacturing versus in the U.S. And these two issues, they're actually not really related to each other. They don't really have anything to do with each other. And even if we built out like a significant amount of manufacturing capacity over the years here in the U.S., we'd probably still be having the same shortage situation. This was driven by some of the dynamics around the pandemic and what some customers did in terms, especially the auto guys, in terms of canceling their orders and everything else. So they don't really have that much to do with each other. And on that note, there's not a ton that the White House or anybody else can really do to address the shortages over any near-term period. Now, to the extent that the shortage situation is sparking the conversation and creating bipartisan support for a deeper investment in localized semiconductor manufacturing here in the U.S., I think that's a good thing. But that's probably the way that those two issues are more linked. It's more the one issue kind of helping to stimulate demand for the other issue.
Why is it a good thing for the U.S. to sort of bring it more domestically, and Europe's looking at doing the same? But is it an efficient use of capital?
Well, yes and no, and I'm going to preface this. I'm of course biased, right? Like I work in this industry, and I do think it's healthy. But I mean, look, the industry over the years has gotten extremely efficient at what it does. And I think to your point, like if you're disaggregating things inherently, you will be less efficient. At the same time, there are some, perceived increased risks from having so much concentration. And it's never quite that good to put all your eggs in one basket. And the way things are looking now, I mean, look, we are reliant on areas like Taiwan, and that part of the world is just getting geopolitically a little more, or a little less robust, I would say, maybe than it has been. And that's becoming perceived as an increased strategic risk. And so I think the industry and the world may need to live with a little less efficiency if that makes things a little more resilient. And so I think that's the discussion that's going on right now.
Of course, a few competitors at the same virtual table today, and we saw competition thick and fast. That was really the news in the semiconductor space, was, of course, NVIDIA getting in even more on Intel's turf. Talk to us about the focus of NVIDIA on so-called CPUs.
Yeah, you bet. And so I'd say the NVIDIA analyst day today, like part of the reason the stocks reacted as well as it did is I don't think expectations were that high going into the analyst. I don't think so it was a little more eventful than people had expected. Now, in terms of NVIDIA doing their own ARM-based server chip, which they announced today, we know they've been working on this for a while. So at some point, people have expected they would announce something. I don't think that people expected them to announce it today, right? So maybe that was a little earlier than what investors had thought. And they're painting a tougher picture for Intel. I mean, like Intel. I mean, obviously the stock has been strong recently on this kind of hope trade, like with the new CEO, hopefully much more credible than like some of the prior management has been and everything else. The problem is, like, it's well known that, like, at least for the next couple of years, there's not a whole lot that he can do, right? I mean, like the path through 2023 effectively is baked, and now with NVIDIA's like concrete announcement, the path, 2023 and beyond maybe just get a little tougher as well. So, it's still early. We don't know how well NVIDIA's products will stack up or anything else, but certainly the competitive environment is set to become tougher, and it's like right at the point where Intel was hoping to get their own product roadmap with its feet back underneath it.
So Pat Gelsinger, yet more on his plate to a certain extent.
Sure.
Well, NVIDIA, is it just like, and how are they doing it so much faster, perhaps, than people had expected? What is it that's such a sweet spot for where it is?
Well, I'm sorry, what was the question?
How is NVIDIA managing to get these things out the door so much faster than people expected post the ARM acquisition?
Oh, no, look, they've been working on this for years. Like, they don't need to own ARM to do this chip, and they'll be doing this chip whether or not the ARM deal goes through. But they've been working on it for years. And I mean, they've been working on ARM servers in general for many years. They had a number of projects. They had one called Project Denver that they actually shut down a while ago. But I mean, they've had a number of iterations of this. So it's not like they just started on it yesterday. It's been years in the making. So it's not like they just got it out immediately. It's just I think people just broadly weren't expecting an announcement at this event. So it's maybe a little earlier than what investors were thinking. But it's not like it's something they threw together.
Okay. Meanwhile, investors certainly liked the early headlines, up 5% on the day.
They also talked numbers up in the quarter. And I mean, so in general, things look pretty good for them right now.
Yeah, always nice when you get a little bit of quarterly update as well. Fantastic always to get your voice on all these things. We thank you so much, Stacey, of course, the Managing Director of US Semiconductors over at Bernstein. Such interesting takes when you get the research from him. Meanwhile, well, that does it from this edition of Bloomberg Technology. Tomorrow, I'll be joined by US Senator Marsha Blackburn of Tennessee on transportation and Biden's infrastructure plan. I'll also be joined by Initialized Capital founder and managing partner Gary Tan as we continue to preview Wednesday's Coinbase listing. Thank you so much for joining us. Stay happy, healthy. This is Bloomberg.